impact of currency, crude oil on commodity prices and on commodity markets. I'm now going to invite Dr. Feroze, Chief Economist, Joint Plan Committee of the Ministry of Steel. Again, Dr. Feroze is no stranger to this forum. He's been coming here the last 4 or 5 years, certainly that I have known, we have known each other. And he does not have a formal presentation, but he's going to speak to us, address us extempo, and share his thoughts on the outlook for the steel industry, steel market. Yes, thank you.
Thank you, Mr. Chandrasekhar, and good morning to all of you. To put it on record, I'm the fourth speaker. And
What will happen to Kunal?
yeah, that's why I put it on record that I'm the fourth speaker, and three eminent speakers before me had actually cleaned up all the points, relevant points that I wanted to make already. So I'm left with very little space to talk about. And in fact, I wanted to talk something other than steel in this forum and focus more on other issues. But it seems that I will be forced to spend more time on steel because nobody has talked about steel so much. Now, all of us seem to be concerned, the whole world is concerned about global growth rates, slowing down of the global growth, economic growth rate, from this percent to that percent. Somebody quotes IMF. Of course, everybody quotes the IMF's predictions, knowing fully well, or if they examine it, IMF has never actually come right. They always make mistakes, and even then we fall back upon IMF or any World Bank or any such organizations for growth rate projections. Now, the problem, everybody is worried about the slowdown or stagnation, but in my view, the world economy is overgrown. It is overgrown to that extent that almost every segment of the economy globally has huge excess capacity, that everybody accepts it. Not only that, industrial or services capacity are in far excess of what is required. There's so much of money around the world and nobody knows where to put the money. Whether it is the money is coming from US, Japan, China, Europe, anywhere. Actually, everybody is trying to find an answer, find a place where they should put their money. Where is the investment opportunity? There's no dearth of money. So we are in a strange situation, a very complex situation where we have excess capacity, we are overgrown and still looking for growth. Now there are many reasons we can talk about later why we are looking for growth, why we see potential, when we look at Africa and India, poverty, then we always want to lift everything up, everybody up to a particular level which will raise economic growth rate and such and such. Let me give an example of the steel industry. Steel industry has excess capacity globally in excess of 800 million tons. That's as per what is being produced, reported by WSA, and what has been assessed by OECD as far as capacity is concerned. And it's growing. And you can see that capacity growth is not stopping here. There are another 200 million tons of capacity are in the pipeline, which are plants constructed, half constructed, ready to be commissioned, etc. This is the first story. Then there are minerals. Mineral sector has huge excess capacity. Now, if you talk about the steel industry itself, if I look at the current capacity of iron ore, coal, manganese, anything that you name any industry, it can support the steel industry twice or thrice over of the present production. So you don't really, what will you do? What will anybody do if somebody has acquired a mine or look for made after great efforts got a mine? So what? What will you do with it? So, when steel industry grows, let me assume that somehow for some miracle steel industry grows, starts growing very strongly. There will be no fresh demand investment, demand capacity in the mineral sector. This capacity is already there. Somebody has to put some money. If somebody is very generous, will put the money in steel, put the money in minerals to see some production line coming up and run a particular business. We're talking about the super cycles. From if you look at steel from 1973 to 2003, what was the average rate of growth in steel production or consumption globally? It is just 1.5%. Today we are still in excess of 3. So we have entered, and during this 30-year period, we had ups and downs. We had big ups, big downs, downfalls. We'll perhaps live with that. What can happen is that we will, on an average, will perhaps remain the same way because of the huge excess capacity everywhere around. Everywhere around there is excess capacity, so we will have to live with that. Excess capacity can be used to even bring up all developmental plans, efforts, whatever is required. Second, even in the case of oil, it's the same story. Now, I just want to make one particular point about oil. There was a question, there was rather debate of how far the oil prices where will oil prices remain, $35 or $45? There are different viewpoints in respect of one currency effect, and the other is demand and supply, who is bringing in more oil or they will bring in less oil. Now, let me put it this way. Shale gas, tight oil, which we're talking about, its production cost is about $45 at the minimum per barrel, and it goes up to $65. What is Saudi's cost of production of oil? $19 to $25. Most Middle Eastern countries fall within maximum $30. That is the average cost of production. Now, with tight oil coming up from USA, had the potential to crush the Middle Eastern Saudi dominance of the oil market. So, in my view, tactically looking at it, I could feel that it could be that they just created a situation to crush that shale gas, shale oil, tight oil industry. And if they're smart, they will keep the prices below $45. They will not allow it to go beyond $45, will not allow shale industry to move further. So if it remains between $35 to $45, basically their expansion will be finished and more rigs will be closed, and they will be in a comfort zone. That will also cause some problem for Iran, some problem for Russia, everybody else, because the Middle East, Saudi Arabia will have the dominance, holding 31% of the world crude reserves. Now, coming to some of the core issues which I thought I would be speaking about today in relation to steel. There are, as I said, there is excess capacity in steel globally. And everybody is concerned about what is going to happen in China, or what will China do, or how will China tactically respond to the current situation of steel. They have excess capacity also about 350 to 400, some estimates say 500 million tons. Their products are coming under, they exported up to 110 million tons last year of steel, which they will find increasingly difficult to export to maintain that kind of a level. So they will be forced to reduce imports. It is very, very unlikely that they will be in a position to keep on expanding steel consumption domestically, so they will be further bringing it down. So if there is a worldwide overcapacity, if China is also, facing such domestic glut, their problems is worsening by trade cases, how is that all of a sudden world prices rose by nearly $100 or so, and it is continuing to increase? What has led the steel prices to increase all of a sudden? There is nothing that is remarkable on the demand side of the market. Where is steel consumption growing? Is it growing in India? It is growing at 5%, 4%, that's all. And India produces most of its steel. 10 million tons of steel, 12 million tons of steel that it imported last year is peanuts in the global context. So where is steel growing? There is no surge anywhere. It's speculation and rumors. A rumor being created very consciously. It serves the Chinese steel industry to run the same amount, produce the same quantity of steel and sell at a higher price. It helps others also. The point is that if I'm selling to, I'm maximizing revenue, then if I'm selling at $200 and selling 200 tons, instead I will sell at $400, I will sell 100 tons. So Chinese there is whatever is happening today, the entire euphoria of steel prices recovering in a big way and everybody believing it to be a demand-led situation is false, is incorrect. There's nothing really happening around that. So the question is, what will happen to what is the bigger concern for the industry? If steel prices do not rise, we have seen, so when it comes to Indian steel industry, you may have already seen that the NPAs are growing, there are debts of the steel companies are growing. That is a much bigger concern for anybody else. And to actually support the steel industry in that, to actually help them financially, the government had already taken many measures like introduction of MIP, and safeguard duties have also been imposed, import duties were increased. So all these measures have been taken to safeguard the finances of the steel producers because they are in bad shape. And finances of the steel companies is not only in India that is in bad shape, it's all over the world is the same situation. So, then why, if finances are, the question is now, how do you go about this situation? Is it that some increase in prices, artificially created or created by the market is going to actually change the situation as far as the core problem of the industry is concerned? It is not going to happen. Nothing of this sort going to happen. Even if there is an increase in prices by another $100, my reading is that it's not going to happen so easily. Why? The steel prices, when it came down to sharply to this bottom, it carried along with it the prices of raw materials. Iron ore prices from $180, it came down to as low as $35. Coking coal prices at a peak when it was $350, it came down to $72. So all the prices had come down in the same way, and when it will move up, steel prices started gaining strength. There will be some bit of it will be taken away by the raw material prices as well. So iron ore prices went up from the bottom. It reached to $50 to $53, and then coking coal prices also went up, other coal prices also went up. There is some kind of movement. So a part of it will be taken away by this. Second, so if you are actually generating more resources, so much of the resources will be going to clearing debts rather than to have new investments. So there is no real growth which will be forthcoming, and the next period for the steel industry globally will be a period of restructuring and consolidation, and that has to be taken more seriously. How you do it, that's a matter of the business. And government policies, national governments everywhere will come together. They will also talk about it. In the last OECD meeting also, we had a long discussion on this matter only. This is the core of the issues. But nobody seems to be having any kind of real grip on the matter. Not that anybody has a solution to it. Everybody has a desire to have certain things coming up. But given between the last OECD meeting and today, there's a big difference. So all of a sudden, one did not know that the steel prices would be actually rising by $100 from nowhere. There's no real ground for it. And today concern is, supposing one more strategic view is taken by the global leaders in steel, national governments or the industry coming together, how are you assured that next 15 days, the steel prices will not drop by another $50 and next 1 month by another $100 and back to square one? Since it is not unsupported, since $100 increase was unsupported, $100 fall will also be unsupported. And no amount of finances in the market can actually alter the situation. So the risk, as far as the steel industry is concerned, the risk that it is facing, it is significant and it's complex. So if supposing there are write-offs, one thing is that there are write-offs. Ultimately, banks said that, okay, fine, you clean up the balance sheets, I clean up my balance sheets, and there are write-offs here, there are all kind of restructuring is done. But that can be done up to a point. The problem is that financial restructuring, give and take, somebody takes a bigger loss, that's a different matter. But how are you going to handle the excess capacity that is lying out there? Are you going to burn down the plants? That, okay, the banks get together and say that X company is having a problem, so I will sort out your problems, we will take a loss, and you also burn down one of your plants. I think that should have been the most ideal situation and most appropriate action. But that cannot be done. That is obviously not true. So the mergers, acquisitions, consolidations, some closure here, something here. I mean, say a new package comes in and the new package ultimately works for a while, and after some time, after a couple of years, it leads to the exactly same problem, exactly the same situation that you started off. So, when it comes to this industry, we are, as far as India is concerned, I mean, we are seen to be a bright spot, although we also are faced with excess capacity. Officially, we have 110 million ton capacity, but if you actually take into some of the capacities which are plants which have been actually constructed and are just ready to be commissioned, not being capitalized. So it will be about 120 million tons already. So 120 million tons and 90 million tons of crude steel production. That means 30 million tons of excess capacity overhang. How do we look at the future? I have seen a presentation which talks about the emphasis the government has on infrastructure, which is going to take steel industries in steel demand. Now the current phase, the major infrastructure that has taken place, I mean, efforts have been on road. Road doesn't take much steel. It's a less steel intensive thing. Steel is consumed hugely in railways, if you have railway development, because it's still very, very steel intensive. Ports, very steel intensive. But our program has been, I think, a slide that showed a 5-year plan of Indian Railways. In that 5-year plan, I think the amount of money that we are actually talking about for new railway lines, I think it is, I don't know, I can't remember the figure, the new track that is considered, are nothing compared to 8,000 kilometers of new railway line that China is proposing next year. So we are talking very small. Now, second, we are more focused on broad gauging. We are more focused on double laning. We are more focused on current speed, increasing the speed of the things. We are more focused on we have to look after the rolling stock. That is in pitiable condition. So they should not only that there will have to be addition, there will have to be replacement. A high speed train, you can raise the speed to 200 kilometers but cannot run on the same track that others are running. So you will have to have all the new tracks, and whether SAIL can actually produce those tracks, or JSPL, whoever has that, can produce their tracks. So you might end up first doing a large comprehensive plan, which is to what is required by the country to actually provide a real railway infrastructure that is nowhere in place at this moment. We are trying to, what is being tried is that whatever available resources we have already, make best use of it with minimal capital investment, so that it runs like a good private sector project with minimal money going in and maximum results. But what we require for the steel industry to gain, it's a massive plan which will be like the plans that China had. I mean, routinely they used to consume 8.5, if even today, 8.5 million ton of railway track material, whereas we routinely consume about 8.5 million tons, and we consume only 2.5 to 3 lakh tons. 0.25 to 0.3 million tons of steel. So we have to go to a completely different level to have the railways going properly, and that kind of a plan at this moment is not there in place. So steel demand coming out of the infrastructure itself will be limited. Second, the government has to play a big role in infrastructure development, and private sector is not doing anything, even though private sector has got more resources at this moment. But there is no investment model where you can bring in a private sector even along with a government support. It's no really workable, superfine model that is available at this moment. So, absence of the private sector from investment in the infrastructure areas, that is a major issue. So that will not allow so much. That will limit the actual funds that will be available to build infrastructure. So we have genuine concern even when we talk about 200, 300 million tons of steel, but ultimately steel consuming areas, if infrastructure has to be developed, industrial capacities consequently will have to be developed. All this put together, if you take a whole picture, we are still way off. So we will live in a world of average 5 to 6% of growth in steel consumption for many years maybe. In between, 1 year it can be 10%, 12%, another year it falls to 2%. So average 5 to 6% growth will be maintaining in the longer run. And that is what the space available to us is there. And that also has been determined by technology factors, because you are not, in your GDP, the steel intensive products share have actually declined. What we have, maybe IT products have a larger share, many other non-steel intensive products have a larger share in the overall thing. So our, even if a country like India, which has got 5, 6 to 7, 6% average growth rate expected, rest of the world is not going to be like that. And that overhang will always be there on the economy unless you are become extremely protected. There is a price to pay for protection also. So what I'm looking at this moment is not that the kind of rosy scenario is not available at this moment. We are still at the beginning of a path, uncertain path. Only thing that we should be careful that whatever policy instruments we have or whatever investment decisions the private sector makes in this area should consider the volatility, should not fall into the trap of speculation, so that there is some bit of steady growth, steady investment decisions which are based on hard reality rather than on fancy dreams. Thank you very much.
Very clearly, globally, the steel sector is in the dumps, if I may say. And my own judgment is that it will take at least 3 or 4 years. The global steel sector, for the global steel sector to normalize and balance demand and supply, it will take at least 3 or 4 years. 2020 probably is the target, my opinion. I'm not talking about the Indian steel industry, I'm looking at a global situation. Second, I think at somewhere we need to stop comparing Indian steel industry with the Chinese steel industry. China is leagues ahead, leagues away from India. 750 million tons production accounting for 50% of the world production. Indian steel production is 1/10 that of China. But remember, Chinese growth story has been for about 20 years. India's growth story is just about beginning. Therefore, I think we need to work out our own strategies for steel consumption. And as Dr. Feroze rightly pointed out, yes, there is a huge emphasis on infrastructure development. There is going to be a huge amount of expenditure on infrastructure development, but that process needs to be accelerated. But railways are not the only consumers of steel. You also have port development, airport development. You have housing and construction, industrialization. I think these are areas I guess will receive a lot more emphasis in future. And therefore, our own steel production will keep improving. Our steel consumption has the potential to rise faster, which will obviously depend on the pace of our infrastructure development, which looks quite positive as of now. I think we have broken away from the sluggishness of the last 4 or 5 years, and the intention to invest more in infrastructure development is very clear. Therefore, I'm possibly looking at a lot more positive picture for the Indian steel industry over the next 5 years or so. It's 11. It's now time for Kunal Shah from Nirmal Bang. Kunal Shah is also no stranger to this forum. Over the next 15 minutes or so, 20 minutes, Kunal? 20 minutes is going to share with us his thoughts on the macro view.
But there are a lot of question marks right now in this forum. What's happening in China, whether the commodity prices have bottomed out. So I have my own perception. I may differ from the views of a lot of panelists, my views. But I mean, the biggest thing, this slide, Mr. Chandrasekhar also spoke about the volatility. I mean, ups and downs. But the one thing I would like to mention before I start my presentation is the state of the current financial markets it tests your sanity, okay? I mean, I remember when I used to track US shale oil production in 2011, 2012, 2013, I used to be bearish every year, believe me or not. I've come up with a report, and every year I used to go wrong. So on the upside, there was an excess. On the downside, there is an excess. And sometimes in all these extreme, we tend to lose our sanity. I mean, no one would have expected in 2014 that oil is going to be $25 or $30. So people having some sanity, doing a bargain hunting at $40 and squaring their position off at $25 would not buy oil. I mean, he would run away. Oh, I don't want to buy oil. So we are back from 25 to 40. So we were trading at 100, now at 40, and we feel, oh, crude oil prices have moved up by 50%. No, but it has gone down too low. It shouldn't have gone down that much. It shouldn't have traded at $100 for 4 years, where US oil production was moving up. So this is the theme, I think, that the sanity is getting tested by the electronic markets. Now the first, what is the theme of 2016? As per me, the theme is there is an emerging market-led recovery. From last 2 years, it was the developed market, US, Europe, Japan to a certain extent, was contributing more, and emerging market have really suffered badly. Now I think the theme is different. It's emerging market-led recovery. Is China really slowing down? I mean, I read this news. I mean, everyone reads this news about China slowing down, problems in China. I have a different perception about it, and I'll show you why it's not a major worry. As per me, China is not a major worry. Is worst over for the commodity? And after BRICS, what are the next? Which are the next nations which are going to come up with a growth in commodity complex? Well, everything has changed after the December 15, when Fed raised their rate for the first time after so many years. I won't go in much detail, but there was an expectation that Fed will raise 6 interest rate hikes. We are going to get 6 rate hikes in 2016. And suddenly, there was a rout in entire emerging market, and Fed changed their stance. And now we are at a scenario, maybe we will have only 1 rate hike, or maybe no rate hike for 2016. So if you look at this expectation, the forward curve, which was earlier so steep, has gone virtually flat. So there's no major rate hike expectation. And because of that, what has happened is the dollar index, which was trading at 101, has come down to 94. Now the entire equation has changed because of the decision of Fed. So now when we know that the dollar index is not going to rally, so we are not going to see a major outflow for emerging market. So emerging market have started to stabilize because there is an expectation that because the dollar index was rallying, it was expected to go to 105, 110, that kind of perceptions were building on, and that's why there was a major outflow going on in emerging market. Now the tables have turned. You look at what happened in Brazilian currency. I mean, can you believe this chart? I mean, the way currency have depreciated in last 1.5, 2 years, it sounds like a bloodbath in entire emerging market. India, to the greater extent, was an exception in this route. But if you look why all these emerging market currency fell so sharply, because commodity prices was falling sharply. All of these Latin American markets, or Russia for that matter, they are 50% of their exports were coming from the commodity, revenue was coming from the commodity exports. And since commodity prices were going down, these currencies have been weakening. And from last 1 quarter, what we are seeing is, because there is a stability in commodity prices, they have come up from the unreasonable levels and right now stabilize. So all the emerging market currencies are stabilizing. So if this scenario persists, even these prices persist, we are going to see a more of stability in emerging markets. So like Sir said, IMF projections, I don't focus, I mean IMF projections or World Bank projections are more about the past. They come with a major lag effect. I mean, they should have come up with a downward in GDP revisions in November or October. They are coming at March month, in April month, they say the global GDP is going to go down. No, emerging markets are doing well. They are stabilizing. If you look what happened to Russian currency, I mean, this is a major disaster, what I have seen. Because of the sanctions what US has put, and after that oil prices crashed, we have seen a disaster. Russian currency from 25 to 80, I mean, insane. And now it's come back to, from 80, it's strengthened to 65. So the perception is right now, what I'm having is, because the way emerging market currency have stabilized, it looked and it seems to me that commodity prices have definitely found the bottom. May it be oil, may it be metals, may it be precious metals. because the major victim was the dollar index. The dollar index, I mean, the rally from 78 to 101, that triggered the major outflows in commodity-led economies, commodity-producing economies, and commodity-producing currencies also. So this one factor is the second factor, which is a major debatable issue for everyone, China slowing down. Everyone says China has slowed down, China is having a whole lot of problem. I don't think so. If you look at this chart, and if you look at the fonts are pretty dim. If you look at the brown regions, that is the north of China. The north of China is basically in recession. And these are the province, or these are the states where these metal producers or heavy industries are located. Now the GDP of these states are below not minus 1.5%, below 1.5%. But if you look the rest of the China, the coastal China, Shanghai, Beijing, and the other parts, most of them there are provinces who are coming up with a GDP of 8%. So it is a total regional disparity. So for example, if Maharashtra is coming up with 8% growth and Orissa is coming up with 2% growth, so you can't say India is slowing down. That's not right. Some of this old economy of China used to rely on metals, on investments, and coal, steel. Those sectors are having problem. And the problems are so bad, a lot of people miss out on the mission of the Chinese government. Their first mission is social stability. Because this region in brown are not doing well, the problem is there are job losses which are taking place. They cannot afford major job cuts. Because the steel industry is having a problem, they have announced that they are going to reduce the steel capacity by 150 million tons in next 5 years, but it is not possible for them to do it aggressively because the job losses are pretty huge. So either they have to shift the population from one state to another state, certain amount of population. So that is definitely a challenge. But the new economy, e-commerce, pharma, software, all these economies are booming over there. So it is a completely different picture of China. Now, a lot of people say the GDP growth rates, it is declining from 10% to 8, 7, 6.7, 6.8. How many of you can say that US economy can grow at a 5% GDP growth rate? Anyone? Can US economy in next 5 years grow at 5% GDP growth rate? Then how can you expect an $11 trillion economy to grow at 6.5%, 7% growth rate every year after doing so much expansion? It's absurd. Chinese economy has, in last 5 years, the size of economy has expanded from $7.5 trillion economy to $11 trillion economy. So how can you expect that economy, that growth engine, the investment-led model, which they are deliberately slowing down? Before any subprime took place, they have taken their measures, they have taken their guards. They didn't want subprime. That's why they deliberately slowed down their economy. So when the subprime crisis hits, you can say US slowing down. But there's no crisis in China. They are deliberately slowing down to avoid the crisis. So I beg to differ with the view of slowdown in China. It's a deliberate slowdown in China. So even if you look at, anyone having a guess what was the Chinese crude oil import growth last year, 2015 versus 2014? 11% growth rate. Is it slowing down? No matter they are building reserves, copper, refined copper imports, 8% up. Even though copper prices is going down. So the demand growth rates have been moderating, but the demand is not slowing down. The demand is as vibrant as it used to be. So now, what next? You heard the story. What next? China has a lot of options. First is devaluation. After the Chinese slowdown, the major buzz in media was devaluation of currency. China is going to devalue the currency. The reason they cannot devalue the currency is this chart. There is a regional disparity. So for example, in order to promote their exports, if they come up with a major devaluation, these states will suffer more. the states who are not export oriented, they are going to suffer more. So they cannot, the first goal of Chinese government is social stability. They cannot do that. So forget about the major devaluation. Second, fiscal stimulus, okay? I don't know how many of you are aware, there is a major anti-corruption drive going on in China. The government is nabbing the previous politician from various countries and putting them in jail. There was a special charter flight, what they took, and there were a lot of politicians, they nabbed them and put them into jail. The reason for that is, in 2009, they came up with a stimulus package of $600 billion. And the slippages, as per the people with I spoke to in China, they said that the slippages were as high as 20-25% of the total package. So they don't want, they are not announcing any major fiscal drive. First, they are cracking those politicians who were a part of this the corruption drive. So China has ample of room for the further fiscal stimulus. They can come up with a further fiscal stimulus. They can spend more. But before doing that, they want to clean up. They are cleaning up. They are holding everyone responsible for the corruption, what is going on in their country. They don't want any major slippages. So this is one more thing. Third is drop in interbank lending rate. Everyone was talking about hard lending 3-4 months back. I remember hard lending was a major issue. But if you look at the Chinese interbank lending rate, they were not pointing towards each week, on week-to-week basis, the interbank lending rate used to drop. So, I mean, when the interbank lending rates are dropping, how can you talk about hard lending? I mean, it should shoot up. So, and last is to deregulate the labor markets. I think I will not speak much on that. So I don't think so that China doesn't have option. Why China is not going to have problem for next coming years? Look at the Chinese trade balance. You see this trade balance from $200 billion to $600 billion. This is the kind of trade surplus they run. And we are worried about China. So I don't see any major worry. But this second chart makes me believe that Chinese old economy, because there is so much liquidity infusion from last 6 months, the lag effect of that is visible in this chart. After falling continuously from 2.5 years, you see Chinese PMI inching up. So the lag effect of the liquidity infusion is clearly visible in the manufacturing PMI. Service PMI anyway is doing good. One more signal, Chinese producer price index, inflation at the manufacturer's level. This was in a deflationary mode from last 4 years, 5 years. And after such a long time, we've seen some uptick. So I'm not saying it's going to move up and zoom up, but the contraction have halted. And that is the reason why commodities are responding. Commodities have responded before these things have improved. Okay, markets have already priced in, things are stabilizing. CPI, the inflation in China is also moving up. Now, why this growth is coming? You look at this China RRR. They have continuously slashed the interest rate, RRR, reserve ratio requirement for banks. And because of that, banks have been lending aggressively in last 3 months. So now you can debate it. Like if they are lending, then after 6 months there can be a problem. I have answers to that also. And if you look at the foreign exchange reserve, which has dropped significantly from $4 trillion to almost $3.21 trillion, you see what happened in this. There was a major drop of $600 billion from the foreign exchange reserve. What they did, they tried to prevent the stock market crash. Okay. Now India needs FDI in our stock market. Believe me, China doesn't need foreign money to run their stock markets. And it is neither their government agenda. But the way markets are falling, in order to prevent that, they use some of the foreign exchange reserve. They use some of the foreign exchange reserve to prevent the capital outflows. And the rest of the reserves are used to infuse in the domestic economy and to infuse in the banks. Okay? And that is the reason why things are improving. Now, if you ask me, have things structurally rebounded? No. There are problems, there are headwinds. But this thing, no one is talking about. One belt, one road. This is the second ambition of Chinese government. After the major infrastructure and investment drive they did, this is what they aim to do. Sir must be knowing. They want their presence to be felt in entire Asia. They want to build this ambitious project of roads connecting China to Russia, to Europe, to Sri Lanka, to even to India. Whether they get permission or not, that is a debatable issue.
It's called OBOR.
Yeah, it's called OBOR, and it's one belt, one road, and they say it's Silk Road. So this is the kind of ambition the government has. And believe me, the government over there and government in democratic country are very different. If they have these ambitions, believe me, they have some serious plan. It is not like they have come up with a document that, okay, we are going to do that and that will keep hope. So these kind of projects will still drive. So don't expect that China's commodity demand is going to die. Forget it. You just have to realize that what happened was too much, and that's why we are seeing a bounce back. I mean, iron ore went to $30. Yeah, the rally started from $30 to $200. But now on the downside, $30 was excess. That's why we are at $50, $55. So it's not about the demand has improved drastically. No, the excess is now covered up by the markets. Now this chart, I mean, a lot of people are saying China mein commodity ka demand slow ho gaya hai. I mean, what kind of slowdown in 2015? You look at the copper refined imports, it's not slowing down. Yeah, at one point of time, the growth rate was 8%, 9%. That has cooled down to 5.5%, 6% or 8%. But the demand is not slowed down. Even you look at the Baltic index, that is a very good indicator. You see after a crash, a Baltic index has also started to move up. Maybe they've started to restock commodities at a multi-year low level. I don't know. They don't tell me what they are doing, but this is my assumption. That maybe they are starting to commodity. I mean, as an asset class, when there was one debate going on in last year in Melbourne, amidst a very high-level meeting, BHP Billiton, and they were saying that either of coming up with stimulus packages, why don't central bankers buy commodities? It was a debate, general discussion. So at least it will, instead of putting money in the bonds, you are buying a hard assets, and because of that, automatically the entire emerging market will do well. So same way, the Baltic index have also started to do well because there is a restocking demand coming from China. Now, debt to GDP, I think we've seen Mr. Rajani talking about the Chinese debt to GDP ratio. I think one should not worry about that because this trade balance, $600 billion, $3.21 trillion of foreign exchange reserve. So whatever debt to GDP ratio, I mean, entire world is having a debt. I mean, let's accept it. US runs on debt, Japan runs on debt. We are living in the world. So I'm not saying it's right, it's wrong. But you should not be really worried about 200% debt to GDP ratio. China not slowing down, it's definitely it's deliberately slowing its economy. Concern still remains. After the massive liquidity infusion, what they have done, we have seen some stability. So I'm not saying it's going to remain stable forever. After 6 months or 5 months, you may see again a bad loans coming up on the books of banks again, and again you may see a concern. So I'm not structurally bullish, or I'm not saying that copper is going to be $7,000, $8,000. No, that kind of scenario, you have to forget it. In copper also, in crude also, the $55, $60 is going to be $100, as good as $100. But I am expecting the bottoming out process have already taken place. After China, what's the next? Okay, now which are the economies who are going to drive the demand growth? Okay, not to the same extent what China is driving. It's Vietnam, Indonesia, India, Philippines, Africa, African countries. These are the countries who can absorb this liquidity. Okay, India needs liquidity to grow. So if you pump $200 billion in Japan, it's not going to have any impact. But if you put $200 billion in India, it's going to have roads, bridges, everything going on. So these are the economies which are going to get this liquidity floating around in global economy, and that will drive some new avenues of demand. So India, from next 5-year point of view or 10-year point of view, the smart city plan we have, obviously our commodity demand is going to improve. I mean, 1-2 months back, Mr. Anil Agarwal made a statement. He expects aluminum demand to go up by 4 times. This is the kind of statement what we are hearing from the market leaders of the Vedanta chairman. So I think that next years you have to see all these economies, what they are doing. Same way for oil, to give my perspective, I think oil also, I'm not bearish, I am positive. The reason for that is second slide. In 2014, in 2015 and 2016, there is a major drawback in investments. Last year, almost $300 billion went out. This year, more than $200 billion is going to go out. So what's going to happen? No fresh investments. And people say US, like Sir said, that US cost of production is pretty high. Even though the raw material cost have dropped, it should be $38 to $40 max. So I expect in next 2 years, US oil production to decline by 1 million barrel. And Iran production, what everyone is talking about, I mean, it's not like starting a tap of water and releasing the oil. So even though Iran can produce 2 million barrels, it's not going to do it immediately. So this year, maximum 5 lakh barrel of production can come from Iran. So US production is going to go down. Iran will come up with a fresh supply. So you should not be worried. I think $35 should be it. Anytime I see $35 oil, I'm going to buy. But I'm not expecting it to go to $60. I think $55, $50 can come in next 1.5 year. So, and I won't be surprised. But those are like $100. If I see $55, I'll tell myself, Kunal, this is $100. You should not see this as a $55. So you are not going to see a structural bull run, but I think the worst is over for the complex. Exaggeration on Chinese slowdown is going on. I mean, I don't understand the way Chinese economy is growing. You can't say that it's really slowing down or it's going to have a major debt problem and it's going to get bust. There is possibility, but looking at their huge foreign exchange reserve, huge trade surpluses, the strong will of the government, no one opposing the government can take their own decision. I think Chinese slowdown is, this year is going to be the year of emerging market-led recovery, and still we are at least a year away what people are talking about our next recession or so. I don't see any recession in the next 6-8 months. I think we are going to see a good stability in broader markets. I hope I've added some value to everyone. Thanks a lot.
Thank you. Thank you, Kunal, for bringing a very refreshingly different perspective to the Chinese slowdown. From what Kunal says, I think there's a huge amount of consolation that there is no slowdown and there's nothing much to worry about slowdown. The fact remains, Chinese GDP growth numbers of 2013, 14, 15, when you look at the official data of growth rate is certainly declining. There is growth, but it's declining. But we must also remember that Chinese decline in the growth rate is from a very high base. And therefore, when they were $11 trillion and they grew, when they were $10 trillion and grew at 7%, currently they are $11.5 to $12 trillion, they are growing at 6%. I think the net addition to the GDP value is more or less the same. Yet, we need to talk about percentages, and in terms of percentages, certainly China is slowing down. Depreciation of Chinese currency is a reality, we can't wish it away. It happened in August. It happened twice last year. And I believe there is a potential for that to happen again this year. Third, there's a desperate move to reform the state-owned enterprises in China. And therefore, their investments in fixed assets are certainly slowing down. There's no doubt. I mean, the data are all available. Therefore, the fact remains China is slowing down. Whether it's a state-guided slowdown or market-driven slowdown is a very different argument or different debate that can take place. But what is also important is, while investments are slowing down, economic activity in some sense is slowing down, or investment-led economic activity is slowing down. Look at the consumption side in China. I read a report recently. Chinese are driving more. In 2015, diesel imports into China reached a record level. They are driving more. Chinese are traveling more. The top line and bottom line of the 3-4 major travel agencies, travel companies are all improving substantially. They improved substantially in 2014 and 15. Many cinema houses, cinema halls are all going full, which means China is spending more money on leisure. For there is a slowdown from an economic activity point of view, from an investment perspective, but from a consumption perspective, Chinese economy is doing very well. I think this is actually the reality, and therefore, it's again, as we have to go back to that word VUCA. This is the VUCA world in which we are living. There's a huge amount of ambiguity and complexity. We need to make sense out of it, and we need to see what best, how best we can perform, and what lessons can we learn from this VUCA situation, and maximize the benefit for oneself, for an individual, or for a corporate, or whatever else. Okay, I think we are actually a few minutes delayed, but yet I want to open the floor for a discussion. You're not going to be able to get this wonderful panel anytime soon, probably only next year. For if you have any questions for these expert panelists, you may shoot. Raise your hand, identify yourself, and ask a question. Yep. Sir.
Good morning, everybody. I'm Mr. Yatin Shah from Prime Industries, Mumbai. I have a question for Dr. A.S. Feroz, Chief Economist, Joint Plant Committee, Ministry of Steel. I want to know, sir, we are talking about indigenization, but for testing metals, steel or aluminum or copper-based alloy, we don't have any import duty on that. Then how Indian industry will sustain? If you import spectrometer for testing metal, there is no import duty on it.
That becomes a capital goods. So there's nothing has nothing much to do as far as steel is concerned.
No, metal. I'm talking about
whatever. That becomes a equipment. There are certain equipments on which it becomes a capital goods. Capital goods duties are very low.
Then how then Indian industry will sustain?
Yeah, I mean, this is a point to be raised, because in any kind of development, I mean, industrialization process in the early stages, you would like to have certain bit of protection. And because these were perhaps not produced earlier, there are many products which are not produced at all, or are produced very minimally. So on those, import duty rates are maintained low, so that the user industries are not unnecessarily burdened. But as the industry, local industry develops, I think if you can provide, I mean, make a case that you are fully capable of actually supplying your equipment and make a case to the government, I think government will listen to you.
50% of these goods are made by Indian company, and 50% is imported from the abroad. This is the situation today.
See, there are different ways capital goods are imported. If it comes under projects, is zero duty. So it can be a piece of steel also, it can be a machinery also, testing machinery, it can be a proper big large machine. So under projects, so many things are imported. And this comes duty free because in the overall consideration of investment.
I think what he says is you need to make out a case for imposing duty instead of making it duty free.
Yeah.
You need to logically argue. According to you, if 100 units are needed in this country, if we are able to produce only 50 units, the rest 50 have to be imported. For that allows an opportunity for the Indian companies to become more competitive, have better supply chain management, reduce your production costs and be competitive.
And zero
I mean, Indian companies very clearly cannot expect a duty protection all the time. And duty protection by its very nature breeds inefficiency. And therefore, this kind of a competition is, I believe, quite healthy for the Indian industry from a long-term perspective.
One clarification, there is no such, I mean, as far as zero duty is concerned, unless it is under certain scheme, I mean, only in exceptional cases, import duty is waived. Even on coal, for that matter, import duty has been levied because it's not considered as an exceptional product. So if it is a machinery are being imported is coming under various kinds of schemes. It could be actually getting imported under advanced license, or it could be getting imported under projects. That's all.
Thank you. Next question, please.
Say one side we are putting MIP and safeguard duty on imported material for steel basically, and second side we are allowing other countries to put their plant in India. Like BioSteel, they have started plant in Ahmedabad, that is Chinese company. Then POSCO Steel is also, they have put a plant. So what is the reason behind it?
As a general government policy, as a part of a general government policy, the government encourages foreign direct investment, would welcome anybody to come and invest in the country, whether it's steel or any other
But our
product.
steel industries, they are having extra capacity
No,
against demand.
yeah,
Excess supply, excess capacity, then also we are allowing other countries to put them.
No, let me complete it. So we have a general policy to attract foreign direct investment, which still is not excluded from it. If somebody finds an opportunity here, is welcome to invest here. That is a general point of view. Second, I mean, if somebody invests in an over capacity situations, coming back, must have assessed the opportunities out here, and the worst case scenario, maybe just displace another guy over here if market is not improving much, and take its position with its competitive efficiency. Now, there's a completely different issue from the introduction of MIP or various kinds of urgent measures which have been introduced recently in the steel industry. MIP has been introduced, or safeguard duties have been imposed, import duties have been raised over a period of time. That is to face exceptional situations where the steel prices, for example, hot roll coil prices went down, CNF prices went down to $290 to $295 a ton. That is certainly not the price in which the steel industry can survive. I mean, there was a serious problem. For whatever reason, it is one of them that where steel companies got indebted, heavily indebted. So it caused problems for the financial sector, banks in particular. So the banks are institutions whose health is most important in any economy. So you cannot possibly allow banks, fortunes of the banks to be dragged down by performance of an industry, one or two industries, not only just one, because of external conditions. So some urgent measures had to be taken, and this is one of them, to safeguard the industry, steel industry, and to give a space to the industry to raise more revenue and pay back the banks and safeguard the interests of the financial sector in the country.
Thank you. Basically, there's no nexus between MIP and allowing FDI in the steel industry. There's no connection at all. These are two different aspects altogether.
Hi, my name is Dhaval Shah from Medco India. My question would be to the gentleman from Nirmal Bang. I think when you're giving your projections about China and what is likely to happen there with the GDP growth and how it's likely to perform as a market, one thing that occurs to me is that considering that there is a trade surplus, and there's a huge trade surplus that they have, and they are largely export driven, that's the reason that the surplus is there. Now, let's say a country like India, which is sort of trying to secure its industries by having MIP or safeguard duties. Likewise, there's a concern that is going on in Europe, US as well. So this export-driven economy like China, when it faces the world, which is trying to sort of be more and more, let's say, protective about its own industry, has that been factored into your projections or not?
Like you pointed out, we are, instead of expanding the global trade is likely to shrink because of the protectionism which is going on. But I believe that it is not going to impact China in that greater extent, because they know already that these industries, whatever they are banking on the export, they are not going to do well. They are trying to do a lot of R&D and shift to the other growth-led model. But my forecast also believes that even though the GDP growth rate goes down, you should not worry. Even if you see GDP growth rate going to 6% or 6.2%, whatever, you should not worry, because the other sectors are picking up and responding very well. Chinese service PMI is expanding from last 9 months there is a continuous uptick in the service PMI. So they are changing their model. They know the old model is not going to work. So yes, the concern will remain for the excess capacity, and that will always on. So I'm not saying that it's going to grow rapidly or no. There will be a deceleration in growth, but you should not worry. The world is really making, my forecast is that what world is doing is really panicking about China. There will be hard landing, there will be slowdown, there will be crash. Because of China, world will suffer. That kind of forecasts which are there seems little exaggerated to me.
Actually, your question is absolutely right, and I have a second opinion on what Kunal you are saying about this. See, we are emphasizing on the $4 trillion worth of foreign exchange reserves, which China had one time 6 months or 7 months back. And that reserves are largely because of the export orientation of this particular economy. That particular investment-led or export-led economy is changing towards consumption, and we have seen a kind of a 1 trillion downfall in reserves. In last 1 year from 4 trillion, they are standing at around $3.2 trillion right now. When this export orientation towards the service orientation happens, don't you think that the surplus or whatever we had from the budget surplus or the foreign exchange reserves would be impacted largely? What's your say on that? And therefore, will the reserves would be enough to take care of the slowdown, what we are banking upon too much on the reserves as of now?
Yes, I think it will be enough. The reason for the same is that what they have consumed in their economy to prevent. The stock market fall has been arrested. The capital outflow which was going from China, that is also arrested. I tell you some of the wonderful facts what I was reading. When I was reading some articles, the Chinese state-owned enterprise, I don't know how much you are reading, they are buying assets in abroad. They bought assets at Petrobras. They bought a land deal at Brazil. They did a biggest land deal. Today morning only there is a news that they did a biggest land deal in Australia. They bought some Australian company at $400 million. So on one hand, we are saying that they are slowing down and they are having a whole lot of issues. And on the other hand, they are buying foreign assets. So I believe that when an economy reaches to a level of being a superpower, I mean after US we have a China, second largest economy, whatever they are doing very silently. On one hand, slow down. On the other hand, they are buying assets. Chinese investors, forget about investors, Chinese state-owned entities are buying assets outside of China. So I think what they are doing is, I think you should not worry. I think they'll manage the storm.
Thanks, Kunal. I think I'm afraid I need to conclude this session. We have
last
already
question.
overshot this time. All the speakers are going to be available during tea break. Please interact with them and ask them probing questions. I just want to thank each one of my young and wonderful panelists, Kunal, Naveen, Dr. Feroz, and of course Rajni for being such wonderful speakers and for answering questions. We'll conclude this session. I just want to say a big thank you. Thanks. Can we leave?
I request to wait for a couple of minutes. We had a very wonderful session. We covered a wide range of topics, right from geopolitics to pricing to China to India, from Euro. And I would agree with Mr. Shah, who had give a different perspective on China. What we are witnessing in China is not accidental. In fact, that is something very planned, considering the geopolitics in the confrontation between US and Russia and China. Now, I would request Bina Verma, the CEO, to come over the dais to formally conclude this session by presenting the mementos. I request Sushma to join. I request Bina Verma to present the memento to G. Chandrasekhar. To Mr. Naveen Mathur. To Mr. Shah. And to Ms. Sinha.